All right, we'll finish up chapter 11 with problem 11-20, and that's on page 11-50. So in this one, Pell Corporation's property, plant, and equipment and accumulated depreciation accounts have the following balances, and they give you everything that's in tangible fixed assets. The various methods that the corporation has selected is for land improvements, their straight line depreciation over 15 years. Buildings use 150% declining balance over 20 years. Machinery and equipment is straight line over 10. Automobiles are 150% declining balance over 3 years. And depreciation is computed to the nearest month. No salvage value on any asset is expected. And then during 2013, so the section at the top, the tangible property, plant, and equipment is as of last year, December 31st, 2012. So during 13, they had 5 transactions. On January the 2nd, machinery and equipment was purchased at a total invoice cost of $260,000. It included a $5,500 charge for freight, and installation cost of $27,000 were incurred. And then in March, we bought another new machine on March 31st for $5,800. I'm sorry. On March, a machine that was bought for $58,000 back on 2009 was now sold for $36,500. So we'll have to compute the depreciation on that and then compute the gain and loss on sale. And then on May 1, expenditures of $50,000 were made to repave the parking lots in their plant location. This is important. The work was necessitated by damage caused by severe winter weather, of which we can all relate to here this week. And then on November 2nd, they acquired a tract of land with an existing building in exchange for 10,000 shares of common stock, which had a market price of $38 a share on that date. They paid legal fees and title insurance totaling $23,000. The last property tax bill indicated an assessed value of the land of $240 and the building for $60. Shortly after the acquisition, the building was raised at a cost of $35,000 in anticipation of the new building construction in 2014. And then lastly, on the last day of the year, they bought a new automobile, paying $15,250 in cash. And they traded in an automobile that was bought 2 years ago on January 1, 2012 at $18,000. The new automobile had a cash value, if you had not done any trade-in, of $19,000. So what we want to compute is the depreciation expense on land improvements, land improvements, the building, machinery and equipment, and automobiles. All right, land improvements, we started with a cost, bless you, of $180,000. And we do straight line depreciation on this particular class of assets over 15 years. So dividing that by 15 gives you $12,000 in depreciation. So what about this parking lot that was repaved? Should we include that in land improvements? Got a 50-50 shot. Who says no? No one. You're all wrong. Because it is repairing damage that occurred because of severe winter weather. That is not a new asset. That is a repair and a maintenance. You would expense that because it's incurred. All right? All right. That was fun. Buildings. Buildings is using 150% declining over 20 years with a 20-year life. So we first have to compute the book value. So that's the $1,150,000 less, I'm sorry, not $1,150,000, it's $1,500,000 less the depreciation at the beginning, accumulated depreciation at the beginning of the year of $350,000. That gives us a book value of $1,150,000. We're going to multiply that by a rate. So what's the straight line rate on 20-year property? What's 100% divided by 20? 5%. 150% declining balance, you would use 1.5 times that, or 7.5%. And that will give you $86,250. So what about the building that we bought when we bought the land? Why don't we include that in here and depreciate it? Or should we include it in here and depreciate it for the period of time that we owned it? You got a 50-50 shot again. Who thinks we should include it and depreciate it? Nobody. Good. You're learning. This building was immediately torn down. So we add the cost of it to the raw land. So whether or not we debit investment in land, because we're not putting it into operation yet until we build the factory or whatever we're going to build on it in 2014. So the total cost of the land, and they give you a bunch of extraneous information in here to kind of trick you on this, because they told you how much the fair value was of the land and the building, so that you could apportion it under a lump sum purchase between the two, but you don't need to do that, because all you did with that building is tear it down in order to prepare the land for construction that starts next year. So that entire part there on number 4, so the $380,000, which is the fair market value of the 10,000 shares at $38 a share, plus the insurance and legal fees, and the cost of raising the building of $35,000. All of that goes into the raw land purchase. So none of it gets depreciated. All right? Well, let me write that up here just so you know. Land. So we started with 10,000 shares at a market price of $38 a share. So that's $380,000. To that, we're going to add legal fees and title insurance of $23,000, and the cost of tearing down the old building of $35,000. So that's $438,000. And I would put it to investments. on land initially, so that at the end of 2013, you're not putting it into the property, plant, and equipment section of the classified balance sheet. Put it in the long-term investment section until such time that you build whatever it is you're building there. Okay? Yeah.
Oh, the 7.5% of the building?
Yeah.
We were using declining?
No, 150% declining. Yeah. Yeah, which we're also going to use for automobiles. We're going to do 150% declining balance on that here in a second. Okay? All right. So the machinery, we started the year with $1,158,000. We sold a machine worth $58,000 during the year. That leaves us with $1,100,000, and we do straight line depreciation. Yes, straight line depreciation on machinery and equipment over 10 years. So divide that by 10, and we get $110,000. Now, to that, this machine we sold, we need to take if we divide that by 10, we're going to get 5,800, and then we're going to multiply that because we sold that on March 31st. So we need to depreciate it from January 1 to March 31st because we owned it and operated that machine for the first quarter of the year. So 3/12 is 1,450. And then lastly, we purchased a machine on January the 2nd for $287,000. Divide that by 10, and we get $28,700. Add all that up. The depreciation on all the equipment that we owned at the beginning of the year, plus the 1 quarter of the machine that we sold, plus the machine that we bought essentially for the entire year, and you get a total of $140,150. And that's depreciation on machinery and equipment. Yeah.
So it's like March 31st, 30.
Yes. Yeah, during the current year. All of these transactions occurred during 2013. All right, the last one is the automobiles. In automobiles, we need to compute, just like we did on buildings, we need to compute the book value. So that started the year with $150,000, and we had $112,000 worth of accumulated depreciation. So we have $38,000 as our book value in automobiles for 2013. So if we're using automobiles over 3 years, what's the straight line rate? That's an easy one. 33 1/3, right? Times 1.5 equals 50%. And that's going to give us 19,000. If you add it all up, the 430, no, not that, the 12,000 for land improvement depreciation, plus the 86,250 for buildings, the 140,150 for machinery and equipment, and the 19,000 for automobiles, we get a total of 257,400. Yes.
What's the 30
This, the 33 and a third, that's 100% divided by a 3-year useful life. So 33 and a third percent. And then 150% of that is 50%. Okay? So what about the gain and loss on the 2 assets we sold? We sold a machine that originally cost $58,000. We bought it in 2009, and machinery is depreciated straight line over 10 years. So we're going to have $5,800 per year for four full years, 2009, 2010, 11, and 12. So for 4 years. That's going to be I can do this 10, 20, 23,200. Yep. Plus the little stub depreciation that we just calculated on that machinery, $1,450. That's a total of $24,650. Actually, let me write that up on the side. We sold it. Oh. That's the amount of depreciation. If we subtract the $58,000 from it, we have a carrying value of $33,350. That's the book value on that machine. We sold it for $36,500, giving us a $3,150 gain. All right? What about the automobile that we sold? Let's see here. What did it cost us originally? $18,000, right? Yes, the trade-in on the automobile was purchased on January 1, 2012 for $18,000. All right? So if we have $18,000, we already know that automobiles are depreciated by 50%. So we have 2012 and 2013. So that's going to give us $9,000 in depreciation for 2012 on that automobile. Then In 2013, we're going to depreciate it another 50%, leaving us with a book value at the end of 2013 of $4,500. So what, in essence, was the trade-in allowance? Well, the cash price on the automobile was $19,000, and we paid $15,250 plus the car. So the trade-in allowance has to be $3,750. If we have a book value of $4,500 and we traded it in for $3,750, we lost money on that one. A loss on trade-in of automobile, $750. Well, that's in essence the well, just to show you that I'm subtracting that from the sale price, just like I did over here. Here's our book value. Here's our sale price. Came up with a gain. I was just being consistent.
What was our sale price for the automobile?
The sale price is the cash price of the car. The problem tells us that if you bought the car for cash and didn't use a trade-in, it would have been $19,000. But we traded in that car that we have on our books at $4,500, and then we paid $15,250 for the new car. So the difference there is our trade-in allowance. Right?
I have a question.
Yes.
19 is the
Cash price of the new car. If we'd have paid cash for the whole car rather than trading in our old car. Okay? Questions on this one? No? All right, problem number 2 on page 43. And like I said, when I'm done here with this template, I'll post it on Blackboard so that you can see how I solved this problem. Your problem is similar. Now, your problem is, well, and I'll show you here in a second, your template is slightly different in that it's asking for, and I'll do that first. It's asking for the depreciation rate. Okay, this is your problem. So it's asking for how much is the rate of depreciation under straight line, how much for on the activity, hours worked, units of output, sum of the year's digits, what's the denominator, and I'll be solving that in the other one. And then on this one, the double declining and the 150% declining, this one, when you get the right answer, you're going to have a little red asterisk because the template's wrong. So ignore it. Okay? So that's your problem. That's the problem for homework. Okay. This problem is asking you, Lord Company purchased a machine on January 2nd, 2013 for $70,000. It had an expected residual value of 10,000 with a life of 8 years or 24,000 hours. It furthermore has a capacity to produce 100,000 units over its 8-year life. And then during 2013 and 2014, it tells you how many hours and how many units in each year that it either ran or produced. So you want to do a schedule showing the depreciation expense and the remaining ending book value for 2013 and 14. All right, so equals 70,000 divided by 8 years is depreciation. Sorry. Oh, 70,000 minus the residual value. So minus 10,000. Divide the depreciable base of 60,000 by the 8 years. And that will be the depreciation for both 2013 and 2014. So the book value at the end of the year is just the original cost of 70,000 divided or minus the 7,500, and that is going to be 62,500 at the end of 2014. After we do another depreciation, annual depreciation of 7,500, we'll be left with 55,000. Okay? All right. Activity based on hours worked. So on this one, we're going to start with the same 70,000 minus the 10,000 residual value, only now we're going to divide it by 24,000 hours. That will give us, and on your problem it's asking you for the rate. So if I hit enter here, we get a rate of $3 or thereabouts. All right? But it's not asking that. It's asking on this particular problem how much depreciation expense. So for 2013, we ran it for 2,500 hours, giving you depreciation of 60,000. Let me just pop these in real quick. All I'm doing is that the formulas, once we calculate the depreciation each year, then the ending book value is always going to be the same no matter what the depreciation method we use. It's always going to be the beginning book value minus the depreciation expense. So I just dropped those formulas in, so now all we got to do is calculate this. So the activity on the second year is the same calculation, the 60,000 depreciable base divided by the 24,000 hours, only now in 2014 the machine ran for 3,000 hours. So 7,500 for 2014. And you can see all the asterisks go away as I drop in the correct numbers so we know that it's correct. Units of output is the same calculation. We start with the 70,000, subtract once again the 10,000. Only now we're going to divide it by 100,000 units and then multiply it by the 12,000 units that we produced in 2013. If I copy that down, the same calculation, the only change is that we produced 15,000 units in 2013. 2014, giving us 9,000 in depreciation for that, based upon activity method, units of production on units of output. Yes? So far? Because here's where it gets fun. Sum of the year's digits. Oops. We're going to start with our depreciable base. And we're then going to multiply it by n, which is 8, times n plus 1, which is 9, because it's an 8-year useful life. So n is 8 times 9, then divide that by 2. And we'll need another parentheses there. So all I'm doing is I'm taking the depreciable base, the 70,000 minus the 10,000 residual value, and then I'm multiplying it by 8 times 9. I want to do that first for 72, and then, I'm sorry, divide by 2, not multiply by 2. And then I'm going to divide that 72 by 2. All right? And the fraction then, I got one more to put in here, is how many years are left in the life of this asset. Because that 36 is the denominator under units of production. Okay? Under the sum of the year's digits. So 8 times 9, 72, divided by 2 is 36. So in the first year, you're going to take the depreciable base of 60,000 and multiply it by 8 divided by 36. 836. And that's going to give you, now you'll see, I got an asterisk here. Anybody guess why on these templates? See the little comment there? If you've got, anytime there's one of these little red triangles in a cell, that means there's a comment there. And it says, round your final answer to the nearest whole dollar. I didn't do that. So if I come up here and I put round, comma 0, and the asterisk goes away. So all I'm doing is I'm rounding that calculation because it came up with $13,333.33 and a third is really what it went, 0.333333 is what the calculation came up with. Because that's the 60,000 times 836. All right? So I need to round that to only $13,333, period. So the function in Excel is round, and you're going to have this issue in yours because it's asking you for rates. Well, two things. In the depreciation, unless it comes up even like it did earlier, it's always 7,500 or 6,250 or 9,000. So those are all even dollars. But if you come up with one that's got these little fraction, the numbers are this like that 333, then you got to put the round in there. And it also asks you what is the rate on a per hour basis or the rate on a per unit basis. For those two, you have to round it to 2 decimal places. So the only difference is you use the round function and put a comma 2 out here rather than a comma 0. That's all. Okay? Because otherwise you're going to get asterisks in your homework too. So now that we have that, all we got to do is copy that down and change the numerator on the sum of the year's digits to what for 2014? 7, exactly. Because the numerator is how many years are left in the life of the asset. And in this case, it'll be 7, and that is, in fact, the correct answer. Okay? Am I losing some of you because of the Excel stuff? I hope not, because I'm hoping that every one of you is going to pass the MOS or has already passed, like some. Okay, declining balance. There's a couple of things different here. One, we're going to multiply the book value, not the depreciable base. Whether it's 150%, 125%, or double declining balance, you use the book value times the rate. And what is the rate for double declining balance? Well, it's 100% divided by the number of years. So 100% divided by 8 times 2. Right? So 100% divided by 8 is 12.5%, times 2 is 25%. 25% of $70,000 is $17,500. Because 50% would be $35,000, and then 50% of that is $17,500. That leaves you with $52,500, and now all you got to do is copy that formula down. Because you don't have to anchor it like you did up here. Did everybody notice that I did that up here? You had to anchor it to the original cost, not to the book value. So when you copy these formulas down for straight line and this and the units of production and all that, you got to make sure you're going back to the 70 minus 10,000, not the, in this case, 63,750 minus 10,000. You'll get a wrong answer. Okay? So I will post this on Blackboard so that you can see the actual formulas that I'm doing. Hopefully you will understand them.